All right, guys, let's get started. Welcome, everybody. Today is Wednesday, November 13th, 2024. This is You've Got Options for Income Navigator. Today, we have a topic that I wanted to discuss for some time. This topic comes up in our community quite often, so I think that it's great to have a conversation to kind of share my thoughts on this topic. And the topic is rolling short options, especially in times when the underlying asset is moving against you. But before we get into all that, a quick disclaimer that we are not a broker dealer. We're not a broker. We're definitely not your broker. We don't provide investment advice. Everything we do here is for informational and or entertainment purposes only. Please consider speaking with your financial licensed advisor before making any investment decisions. If you are seeking an investment advice, you're in the wrong place. This would be a good time to exit this meeting by hitting leave meeting. So, with that being said, we are going to move forward and let's give it a second here. So, the first thing we're going to talk about is managing trades that are moving against you, right? It's very easy to sell a put, sell a call, right? Far out of the money, high probability, everything seems easy. And a lot of times you are going to get the easy money until that one time where the underlying asset is going to move against you. If you're short a call, right, you're betting that the underlying asset isn't going to move too much to the upside or against you. If you sold a put, you're betting that the underlying asset isn't going to move down or against you. But if this happens, right, you have options. You could potentially manage your position. You can do some things to defend your positions and potentially put yourself in a better position to make money. Now, rolling positions in the same as closing out a bad trade and reestablishing a new position. You know, a lot of times we hear things like, oh, I'm just going to roll. I don't have any losers. You know, I'm a super trader, this, that, and the other. But in the end, if you sold a put and the stock or whatever the underlying may be went down and against you, and now your short option is in the red, by rolling it, whether you're rolling it down, whether you're rolling it out, right, for more time and down, you're still closing out the position that went against you. You are realizing a loss and you are reestablishing a new position. And one of the things that I always say that if you're ever considering doing such thing, and I ask myself this all the time, if I'm considering rolling a position, whether it's just down or down and out, I ask myself if I was not rolling, if I was just looking to enter a new position, right? Would I be putting on this position right now? Right? If the answer is yes, then I think rolling makes sense. If the answer is no, then you should not be rolling. You could potentially put yourself in a worse position. In the end, I think a great question, right, that you want to ask yourself, and you have to be honest with yourself. Why are you rolling? Are you rolling to be right, or are you rolling because you want to make money? Now, rolling to be right, right, defending or protecting your ego is the wrong reason to roll. If you're rolling to make money, you have to understand how are you going to make money. If you are in an underlying that is clearly moving against you, you initiated a position by maybe selling a put, which is a bullish position, and if the underlying is clearly moving against you, right, you are being told by the marketplace that you are in the wrong trade. And now, if you're saying, no, I'm just going to roll for more time, I'm going to continue to roll with this position until eventually I will be right, there is a chance that you may run out of money and or run out of time at some point. It's not a good idea to roll just to be right. It's a lot easier, and believe me when I tell you, I speak from experience. It's a lot easier to realize a loss and not reestablish a new position. You have to think if your price outlook is still the same as it was when you first took the position. And a lot of times you will realize that after taking a loss, you start to think about the underlying or the near term price of the underlying a lot different if you were just closing out position and not reestablishing a new position rather than closing out a position, rolling out for more time, saying eventually I will be right. Before you know it, you're 6 months in a much worse position. It's never a fun position to hold. So rolling to be right is wrong. Rolling to make money, you have to understand how you're going to make money in your new established position. So, objective for today is to understand when and how to roll short naked puts. And I'm going to use short naked puts. This applies to short naked calls as well. But a lot of times we get caught on the wrong side of the trade selling puts naked, right? So, for this presentation, we are going to use puts, but the same should be applied and can be applied to short naked calls as well, or both. So the first thing you want to do is if you're considering rolling your positions, you have to understand where you are in the trade. You have to understand your P&L, right? You also want to understand, I think this speaks to, those that do option selling in a mechanical approach where you sell puts or calls or both or whatever, you have to understand that, over the past 6 months, how much do I make on average? Like you need to know how much does this trade bring in on average over the past, 6 months, a year or more, right? And where you are right now in your losing position. If your losing position is like 10x your normal profit result in this trade, I think number one, rolling is maybe already too late. Number two, you don't want to have, one trade be, a 10x loser of your average winning trade. Maybe you're willing to give up two or three good trades, right? To to potentially fix your bad trade. But if things start to get really bad where you're down 5, 7, 10x your average profit in such trade, I think rolling is not a good idea. So you also need to understand where your P&L is. A lot of times people get into this, oh, I'm just going to roll because they get into this false sense of security that, oh, rolling is an option. Great. I'm just going to roll. I'm going to roll for time. I'm going to, and before you know it, if you don't track your P&L, you don't know what your actual rolling P&L is, you end up in a position that's down 30x your regular income, and eventually you will realize how much money you have lost, right? So keeping track of your profit and loss when you consider rolling is a very important part. Now, you also want to understand how far you have until expiration, right? So I see people that are in a position where they may sold a put, the trade is going against them, and they don't realize that it's time to do something about this trade because they feel like, oh, I still have 18 days. 18 days is nothing. It goes by so fast. And if you think that your short naked put is going to somehow magically improve in the last 18 days, what you're not realizing is that now you're racing against the time, and you're also, with every passing day, your short gamma, which is one of very important Greeks to consider when you're selling options naked, is working against you. And with every passing day, it's only going to amplify and it's going to get worse unless things magically improve. So if you're betting on things somehow magically improving in the last 3 weeks, well, one of two things is going to happen. Either you get lucky and you do get bailed out, right? But then that could potentially train you, or it might actually um, establish a really bad habit of letting things go too far or too close to expiration without doing something. And the one time when you're not going to get bailed out or things aren't going to just magically improve, you're going to get punished really, really bad. Time to expiration is extremely important. The closer you get to expiration, the crazier things may get, right? We know that short naked options get extremely sensitive to price swings in the last couple of weeks, right? And if anything closer to expiration than 21 days, you're really starting to run out of time. So the more time you have until expiration to consider making adjustments, the better off you are. So I always say you should consider adjusting earlier. Don't say, "Oh, I have 3 weeks, I have 7 days, it's going to be okay." The more time that goes by, the closer you get to expiration, the harder or the more dangerous your position is going to become. Now, there are several things that I use, right, when I'm considering adjusting my positions that go against me. Number one, and probably this is probably one of the most important ones, is the delta. Always look at the delta. Don't look at the price. Price doesn't really tell you much. I mean, you can look at the price on the chart but then you're introducing another variable. It's your ability to read price action and be right more than you're wrong based on your technical analysis. So one thing that I use is delta, right? So if I sold a put, and let's say I sold a put at delta 10, I'm not going to let it go to delta 100, or in this case, if it's -1, which means -100, this means that your short options is so deep in the money. Now it's going to do two things. Number one, it's going to make rolling extremely difficult, and also you are now facing a risk. If it's a not a cash settled instrument, if it's a regular equity, or if it's an option on equity, you are facing a risk of early assignment, right? So if you sold, let's say, a put on SPY, right, and it's now deep in the money. Maybe the delta is not -1, but maybe it's delta -8, right? Minus zero point 0.8. So it's like minus 80 delta. It's deep in the money. It's a short put on SPY. You think you have, oh, I have 4 weeks until expiration. It's okay. It isn't, because if the option that is short goes deep in the money to a point where there is no more extrinsic value, and especially if there's a dividend coming up, there's a very good chance you're going to get assigned, right? That option is going to get exercised, and you will get assigned on that short option. So waiting for the delta to go too deep in the money, the deeper in the money it goes, the more difficult it will become to do anything about your bad trade. So you have to roll not just early in time, you also want to be proactive and roll early in terms of delta. If I sold a delta, maybe 10, if that delta is going to double, I don't care how much time there is until expiration. I'm going to look to roll that delta down. Rolling down may not bring in enough credit, right? Just to do it a down roll, meaning if I sold a put, let's say on SPY at 450, and now that delta went from 10 to 20, I'm considering a roll down. I'm going to roll from 450 down to I don't know, 440, right? By buying back the 450 to sell 440, it's going to be a debit. I'm looking for a credit on that roll, so I'm going to have to roll not just down, but I'm also going to have to roll out in time. So maybe extra couple of weeks. But I'm not going to wait for my naked put to go deep in the money where there's no more extrinsic value, no more extrinsic value left. All there is intrinsic value. Rolling down and out isn't going to work. In the best case scenario, you might be able to roll just sideways, dollar for dollar. But then again, you're not really improving your position. And we'll talk about that in just a little bit. Another thing to consider is implied volatility on the front month, right? You can look at an option chain and you can look at where is the IV in the front month. This is where you're short, and look at the IV of where you're going to roll. We know when things get a little crazy, implied volatility is going to spike on the options that are closer in time until expiration. IV is going to increase higher than those that are a little bit farther out in time. So essentially, if you wait too long and front month IV goes too high relative to the back month, you will essentially buy the more expensive IV and you will sell the less expensive IV, kind of putting you at a disadvantage. I think delta is the most important metric to use instead of IV, but IV is important nonetheless. So let's talk about the when, right? And I kind of went ahead a little bit and already spoke about this, but we want to roll before short option reaches delta 30. To me, 30 kind of already indicates that, this is you have to stop, stop watching. Maybe if you're watching your delta go from 10 to 20 and you're like, all right, you know what? Maybe I'm just going to give it a little more time because whatever reason, right? When it goes to 30, there's no more thinking because anything beyond 30, it's just going to make it more and more difficult. Higher delta makes it more difficult to roll. You're going to have to roll. You won't be able to roll down enough, right? So instead of rolling maybe, let's use the same example on SPY, rolling from 450 to 440. If you wait for your short put to go at the money, you may not be able to roll down 10 points and out a couple of weeks. You may be only be able to roll down 2 points instead of 10 and down and out a couple of weeks. The higher the delta, the more difficult it becomes to roll. You won't be able to roll it far down enough. So, and that's why I said, don't wait for the deltas to get too high. Try to roll um, early on. When it gets to 20, this is your cue that, you need to go and do something. If it's at 30, you have to not go and do something. You got to run to do something. Now, approaching break even, some people use that, and I've seen this a lot. I'll roll when I get to break even. When you get to break even, right? If let's say the underlying is trading at $500, I sold a 450 put. If the underlying is now trading under 450, this means that my delta is now possibly higher than 50. This is 150% signal that you got to go. You have to make adjustments because now not only is it going to be more difficult to roll, but now your option is getting in the money. And depending on how much extrinsic value there is, and if there is a dividend coming, you actually have a risk of an early assignment. And then you get put shares of the underlying that you really didn't want to own in the first place. You may not have the buying power that's needed to hold the shares of the underlying. It just becomes a really, really difficult situation. And again, don't wait for break evens. Don't when the delta goes from, maybe from 10 to 20, 25, it's time to go. The next thing is, how to roll. There are several times you can roll down, right, by buying back the put that you're short and short a put with later expiration and farther out in time. So this is rolling down and out. Your goal your goal is to collect a premium. You never want to roll down and out and pay a debit because when you roll down and out, right, and you're paying a debit, so rolling down is good. You're pushing your downside break even farther out of the money. Rolling it out, meaning for more time, maybe you roll it out for 2 additional weeks. So you rolled down and out. That's good, right? You have a your downside break even is farther out of the money. Now you have more time. You have an extra 2 weeks to eventually be right. But if you're paying a debit for it, right, you're spending some of that credit that you initially collected. And if you spend too much, you might end up in a position that will maybe break even in the end, or worse, it will be just a smaller loss, right? So again, you got to go back to thinking, why am I doing this? Am I doing this to be right and take a smaller loss, or am I doing this to make money? Right? If you consider rolling it down and out, paying a debit, oh, at least I'll take a smaller loss in the end, you might as well just close the position, rethink your whole situation, your price outlook. Maybe something is off. Maybe you looked at the chart and you read something wrong, and just reconsider the trade altogether. That is the path of least resistance. You also want to adjust strike prices, right? So you want to roll lower. If your option is deep in the money, you probably won't be able to roll much lower, if at all. So your best case is going to be rolled sideways and for more time. So all you're doing is you're just getting more time. And you, again, you also want to always, always, always bring in a credit. Like you have to, for extending your risk in the trade by 2 weeks, 3 weeks, whatever, you need to collect something to make it worthwhile. You don't want to extend your risk by an additional 2 weeks and get nothing for it, right? That's just the wrong approach. Ideally, right, if I'm short a 10 delta put and it gets to delta 20, 21, 22, I'm going to look to roll down and out. I want to roll it out. I don't want to roll it out 6 months, right? You should be able to roll it just maybe a couple of weeks, maybe 3 weeks, and you want to get your delta back into the low teens, right? So you're kind of just resetting the trade. You are realizing a loss on your original trade, but you're resetting the trade back to low teens on the short put. You just have a little bit more time. So now, again, you have to understand, are you doing this because you're just trying to protect your ego, or you're doing this because your price outlook hasn't changed since the original trade? Are you still bullish? And I know that it's easy to fall into this, if I liked the stock at 500, at 350, I'm all over it. That might have been the case with a lot of these high flying stocks in 2021, right? And then in 2022, a lot of them lost 80% of their value. So if you loved something in 2021, if the stock is down, 30, 40%, like you have to, think, don't think with your, um, heart. You got to think, like, does it make sense to continue to stay in this trade? But in any case, when you are rolling, right, you have to aim to reset your delta from whatever that delta is back into low teens. Maybe cut it in half, right? If you're rolling from delta 30, see if you can get it down to delta 15. Now, rolling down to delta 15 and 2 weeks out may not be enough. That may be a debit. So now you need to look more than a couple of weeks. Maybe you need to look at 3, 4 weeks, whatever it is, right? You want to drive in extra credit, give yourself a reason to stay in the trade. Now, some strategic considerations. Avoid rolling just to avoid a loss, right? So a lot of people having this, oh my God, I can't take a $5,000 loss. I'm just going to roll. Well, what happens if you roll and you will eventually end up in a $10,000 loss? I can't do, I couldn't take 5,000. I'm definitely not taking a $10,000 loss. I'm going to roll again. Before you know it, you know, you're in this trade up to your eyeballs in losses because look, you know, if unless you're trading things that um, are not trending, but whatever the underlying you may be, if it's S&P 500, if it's gold, if it's bonds, if it's whatever it is, there could be a downtrend that can last 6 years. What are you going to do? Are you going to roll for 6 years just to avoid a loss? So don't roll just to avoid a loss. Just remember, losses are a part of this business. You have to make sure that your losses are controlled. And make sure that you're not taking some ridiculous losses, right? Because you're not applying risk management rules. And you always, 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 I keep saying this, that when you roll, you don't want to increase your cost basis. Instead, you should improve your cost basis. If you're short a 450 put and you collected $5 for it, right? What's your downside break even? It's the strike price of your short put minus the credit. So from 450, you collected $5. Now your break even or your cost basis goes to 450 minus 5. It's 445. If you roll something where you pay a debit, your cost basis or your break even is going to go up. You don't want to increase your cost basis. You always want to improve your basis because, again, you don't want to just continue to punt something or roll something and pay a debit. Before you know it, there is no more credit left, right? The trade has no more credit left because you rolled twice, you paid a debit twice, and now all you're doing is working for maybe a break even or a small loss in the end. And I think this one is a big one. Volatility expectations. The reason I say this is because this really applies to the way I am trading 1-1x bear traps, where I am long put debit spreads with a lot of time until expiration, and my short naked puts are much closer to expiration. So when and if things get a little crazy and the market goes down or volatility goes up or both, right? My first go to is to look to roll my naked puts down and out, you know, 2 weeks, 3 weeks. I don't want to roll 6 months because I don't want to be in that put for 6 months. I want to get out of that put as quickly as possible. And that is because of my volatility expectations. So we know that volatility is mean reverting. We know that volatility might go from 12 to 60, but it's not always going to stay there. We know that eventually volatility is going to collapse. And when volatility falls, it's the short dated options that fall the hardest. So if I'm rolling my put where volatility has increased, I don't want to roll it to where volatility is relatively low. I'm going to roll to another expiration that also has relatively high volatility, and I'm going to ride that wave until we get the volatility collapse. And that's when that trade will go to safety. I think this is a big one, right? Because a lot of times people think, oh, if my naked put gets in trouble, I'm just going to roll it out, 120 DTE, sit on it for, 6 months. And that I think it's wrong, because if you look at the implied volatility of those options, 120 DTE versus the options that where you are, where you have to roll from, right? The IV in the expiration cycle where you're holding your um, short options is probably much higher than the implied volatility of those options 120 days away. So don't end up buying the expensive IV to sell a cheaper IV. I think because when volatility does come in, well, guess where that volatility is going to fall? It's going to fall in the front month where you were, but those 120 DTE, volatility was never there to fall. So it might come down a little bit, but it's not going to be a volatility crush, and you will not be able to get out of that trade anytime soon. So volatility expectations is a huge, huge part of consideration for rolling this put. And again, I think it all goes back to your exit strategy, which needs to be thought about before you put the trade on. You always want to start with what happens if everything goes wrong. You always want to think about the worst case scenario, because if you don't, if you think about the profits first and, exit later, you kind of fall into this warm and fuzzy feeling of, oh, what am I going to do with this profit? I'm going to, and then you don't think about the exit strategy. You don't think about your worst case scenario because you stop after you thought about, you know, what am I going to do after, I get the profit. So you kind of want to think about like before you put the trade on, you say, all right, I'm going to sell this put. I think the market has gone down enough, whatever for whatever reason you're putting this trade on. You say, I'm gonna sell a put because my near term price outlook is bullish. I also think volatility is going to come in, or maybe it's going to remain stable. I'm not expecting volatility increases over the duration. And if things don't go my way, maybe I'm going to punt, meaning I'm going to roll the trade down and out. Maybe I'm going to do it twice. Maybe this is a big one. You have to think about that way before. Maybe if after two rolls, things don't improve, I don't mind holding the stock for maybe 6 months, right? Maybe it's a company that you like, something that you would hold in your retirement account. Okay. If holding shares is not an option, then you say, all right, after, maybe one punt, two punt, at one point do I just pull the plug and say, you know what? Whatever I'm trying isn't working. Clearly, the price is telling me something completely different. If I'm bullish right now on price, I'm bearish on volatility. But after rolling the put twice, the trade is not improving. It's only getting worse. Clearly the marketplace is telling you something. So you need to know, maybe if I'm down 3 or 4x my, regular income on the short put, maybe it's just time to let it go. You know, let me clear my mind and, focus on better trades going forward. So you have to have a predefined loss level that's going to say, you know what, I tried everything, I gave it all I got, and I think it's time to part with this trade. Clearly, it isn't working. And also, there may be time where rolling is not improving your position no matter what you do. Or if your price outlook has changed, right? We can go in a trend up, then we go sideways, no trend, and then we could start trending lower. If you, for some reason, and this isn't to say that this only happens to terrible traders where you're short a put at the top of the trend and then the trend reverses. It happens, right? It's what you're going to do about it is going to make you a good trader or a bad trader, right? So if you caught the very top, if you top tick the trend and you short a put at the top of the trend and the trend reverses in your face and it goes down, you have to be able to recognize that. So if something changed in your price outlook, you have to revisit, you have to look at the chart, and if the trend is now down, the chart is telling you something. So if your price outlook has changed, it's time to get out. I don't care if you only rolled once. Don't try to prove anything to the market. The market's always going to be right. Price is king, and price is the only thing that tells the truth. And if you're rolling and you're considering rolling down and out, and the only way you can get a credit is by rolling 6 months out, I don't think it's a good strategy for a roll. I think it's time to get out because you're not really improving your position. You're just buying more time. You're collecting barely any credit. You're going to be in this terrible mindset for the next 6 months. You're going to be miserable. It's easier to get out and figure out how to not put yourself in the same position going forward. Right. So those are some of the things that I wanted to talk about. I mean, we can talk about rolling and we can look at, different examples. We can look at different past trade examples to, figure out some ways we could have done things differently. I love using Option Explorer for these kind of case studies. But my takeaways here that rolling is an advanced technique that requires deep understanding and knowledge of options trading. You have to look at things in 3D. It's not just that simple. Buy a put, sell a put, roll a put. You want to understand, am I rolling into a lower IV? Does it make sense here? Combine it with, looking at the chart using some indicators and whatnot to kind of drive your decision. There's a lot of moving parts, and you have to be able to kind of bring it all together. And again, always, consider instead of rolling, am I better off Now, if you again, if you sold a put at the top of the trend and the trend is reversing, is it better to roll that put, or is it better to take a loss in that put and sell a call? Right? You're considering completely different strategy, but the only way you're going to think about that with a clear mind is you have to be ready to realize a loss in the trade that's clearly working against you. Maybe take a day, maybe take a week, whatever the case may be, let things settle in, and you're going to think completely different. And only then you can decide, now, do I want to reestablish some sort of position in a similar directional outlook? Or maybe you want to capitalize. And if the trend is in fact reversing and you were wrong on your previous trade, there's always a new trade. You just need to understand which way you're going to trade. Those are some of the things that I wanted to share with you guys. I know that we're just barely scratching the surface, and we can talk about rolling in so many different ways, and there's a lot that we can talk about. And we are going to come back and revisit this for sure. If you have any questions, we'll spend a couple of minutes, and we are going to jump. I'm just reading through some questions. Yeah, so Time Merchant saying that Tasty promotes rolling, 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 and there's nothing wrong with it, right? I don't think there's anything wrong with rolling as long as you are applying some of the rules that you need to and you need to consider. Rolling. What am I doing? I'm closing out a bad trade. I'm reestablishing another trade. If you're rolling from, you sold a put at 10 delta, now it's delta 60. You're rolling from a 60 to maybe a 50 delta. Are you really improving your position by much? Because that 50 delta put is going to be 60 delta in no time. You're really not improving your position. You're just kind of kicking things sideways, hoping for something to magically improve. And if you are considering rolling your options from a delta 60 to a delta 10, forget it. In order to get any kind of reasonable credit, you will need to go 6 months out or maybe more. Again, it all depends on implied volatility. Obviously, I'm just making a very general statement, but you're not rolling from a 60 delta down to 10 and only out 2 weeks. No chance. So if and again, like I said, if you're rolling, 6 months out, do you really want to be in this position thinking about this for the next 6 months? Um, but yeah, I hope that this video is helpful and you guys could come back and rewatch this, and maybe some follow-up conversation will spark different conversations in within the same topic, because there's so many avenues that we can explore here. We can go for 4 days talking about rolling. This is just kind of the top, and then we'll dive deeper for sure. uh Jay saying, would love your thoughts on this covered call on MSTR at 400 expiring January 17th. What's happening with the price of MicroStrategy these days, uh, rolling in time? So, first thing I'm going to say is that, you want to look at, so you have the 400 call, and maybe you can tell me what is the delta of this 400 call. I'm going to have a look too, right? And then again, the higher the delta, the more difficult. And I think that, I should have started with this, that when we're doing things on the call side, like everything I said on the call side, things get a lot worse, a lot faster, because options on the upside, unless there is a volatility skew, normally options on the upside don't have enough premium to begin with. So you end up selling options that are very close to at the money. And when something like what we are seeing with um, MicroStrategy, I'm going to share my screen in a second. All right, so MicroStrategy, big move to the upside. I'm going to use this chart here. Oh, Christ. What happened here? They did a good old Splitsky, and Option Explorer is not really picking that up. But anyway, so we did see quite a move. From 200 it doubled. Um, so now we're looking at Jan 17 with 65 days. So at least you got that going for you. But check this out. Look at the implied volatilities. And, maybe Option Explorer isn't displaying correct implied volatilities. I don't really use that to analyze my trades, but it's still a good example nonetheless. So you have options with 37 days and have an IV of 132. And then you have options with almost twice as much time, and their IV is 126, right? So just in the implied volatility terms, right? Just in the implied volatility terms, options with less time to expiration are more expensive than those with more time until expiration. And if you wait long enough, right, where things get worse, maybe they will. I'm not saying they will or they won't. I'm just saying that if you wait long enough, and this is a pretty normal mindset for somebody to say, well, I'm just going to, give it a little more time. I have 65 days. Everything's going to be fine. If things get worse and this IV goes even higher, well, look at the options. Where would you possibly roll? So the next expiration, I'm not sure if there's anything between. Option Explorer has been kind of goofy a little bit with these weeklies. They don't display things. I'm not sure about equity options, but definitely missing some expirations on options on futures. But it looks like the next cycle is the monthly February 21st with 100 days. So you're immediately picking up risk for an additional 35 days, which is a month, maybe a little bit more, right? And let's look at the 400 call, which is not terrible. It's at 51 delta, $60, right? That's what you would have to pay to get out of this position. And where do you roll down and out? So, or well, in this case, it's not down, it's up and out, right? So from 400, this 400 call is for $60. Well, if you roll up to maybe 460, right? You will get, let me just model this. So you buy this call and then you sell a 460 minus one. Again, look at the delta. You are going from 51 delta to 49. You're really not cutting too much directional risk, which means that if things don't improve, if things continue to move against you, don't expect much change from the delta standpoint. But you get to punt your trade up to 460 and oh, I'm not sharing my screen again, huh? Or am I? Can you guys see my screen? Okay, you're seeing my screen. So by rolling up and out, right, you're extending your risk by 35 days, but at least you're collecting, $6.70 to do it. Right? Is that the best? I don't know, right? Because what if things don't improve and the stock continues higher? What are you going to do then? Well, I can roll again. Okay, where are you going to roll to? I'm going to roll from February to March. Okay, but you got to do it soon. You don't have the luxury of time of waiting because the original roll is already very late. Delta is already 50, right? You don't get um to roll it far enough out in time. If this, right, this is 60, this is the new option is already 66, right? Okay. What if I wait and, the underlying continues higher and let's say we get to at the money again, right? What is at the money right now? 350. So let's assume IV stays somewhat similar. What if we get to 460? Well, this this $67 call is going to be almost 100. Well, now you have to look to roll for more time and where is the next 110 call? So you're just digging yourself deeper and deeper and deeper. I'm not making the case that this is a terrible trade. I'm not saying that this is a terrible roll. In my opinion, it's a little late, right? That's why things are a little bit more difficult. I think that if you might have started to roll a little bit sooner, you might have reached a point where you have to ask yourself, am I going to continue to do this forever? Or am I down, 4x my average winning trade? And maybe it's time to cut the cord here and, consider something else. Yeah, Jay, I'm glad that you are agreeing because I think you understand on the call side, there's just not enough juice. There's not enough room. With puts, when things get crazy, um, you can roll down and out and you get a decent amount of room to the downside. On the call side, sometimes things get a little difficult. No weekly options make it also not ideal because look, you're gonna punt this once, twice, but before you know it, you're gonna be in the straight for 6 months. Again, all these things, I make the case for me. If I started with the trade, it goes against me. I try to roll it once, I try to roll it twice. Now, anything else I consider doing that's going to put me in the trade for even longer, it's very difficult. And I'll tell you, for some of you that may know, if you're stuck in a bad trade for 6 months, for 6 months, it's just going to put you in a bad place in your head. It hurts your wallet, but it also hurts your mental capital. And that is just as valuable as your financial capital. Because if you don't have the confidence, if you're in a bad place, if you're now considering revenge trading and doing crazy things, you're in a bad place. You better, you know, change your password and shut down your system and go away and give it a little bit of time to at least cool things down and you don't want to trade from that place. All right, so here's another variable, Jay. I'm glad that this is a covered call. So I'm assuming you're holding the underlying. You're trying to capture as much upside as possible. So maybe maybe you should have led with that. I mean, if it's a covered call, then sure. I mean, you can just continue to punt and punt and punt. I mean, what's the worst thing that's going to happen? They'll take the stock away from you. But assuming that every time you punt, you get a credit, okay, not a big deal. Again, keep in mind, if you don't want them to force you out of your long shares, don't let it go too far, too deep in the money, because once there is no extrinsic value left, there is a reason for somebody to maybe exercise the option. As long as there is extrinsic value in the option that you're holding, and we're going to look at one more thing before I let you guys go. We can look at the extrinsic value of this 400 call. Obviously, it's out of the money with the underlying trading at 355. So this option is trading for $62. The $62 is the extrinsic value. There's no intrinsic. This position has no equity. All of this is hot air, which will go away in 65 days unless the underlying is going to go above 400. So it's not that big a deal. But if you look at some of these very deep, and maybe this is a bad example, but as you can see, that when I start to move, right, these are the calls. When I start to move from 355, right, which has $75 of extrinsic value, this is the time premium. When I start to go deeper in the money, so now from 355, we're looking at 340 is already in the money $15. This option is worth $67.52. A part of it, $15 of it, is already intrinsic value, and the rest is extrinsic value. And as we go down, the deeper in the money the option is, the less time premium there is. And eventually, when an option is too deep in the money, there's no extrinsic value, and that increases a chance of early assignment in the case of a short covered call, again, not worst case scenario, but there's a chance you may get called away out of your long share position, and that could trigger a tax event, right? It will be a realized capital gain, especially if you're holding shares for a short period of. So this things to consider, right? Do you really want to get called away, or do you want to continue to punt to do everything you can to avoid getting called out of your position? In a perfect world, right? It's not a big deal. You say, oh well, if I get called away, no big deal. I'll just replace the shares. But if you consider your tax consequences, then it's not that simple. All right, guys. So hopefully this gave you something to think about. I'm going to save this and I'm going to post a copy of this along with the slides. If you have any questions, I'm going to make it so that you guys can reply to the post. Until next time, if you have any other questions, you can find me on Discord. Shoot me all your questions. I like to interact and answer your questions, and definitely will come up with some more topics to discuss, make presentations, and hopefully bring you guys some value. All right, until next time, have a good day. I'll catch you guys later. Bye-bye.